The secret to really being a great trader or investor is to have confidence. What is your investing confidence? What's your ability to make risky trades and follow a strategy and a plan without deviating? Because you're not worried about how that trade or investment will affect your net worth. You see, you want to have a long-term investment portfolio before you invest in single stocks. You are now in a position to be a confident investor, someone who's ready to do the research and execute the strategy as a cold, calculating investing guru, and not a scarcity-minded gambler who's going from one strategy to the next, hoping to hit their next big score. Do these 5 things before you buy stocks. Have you tried investing in the stock market? And when you do, you always find yourself selling when you shouldn't and buying too high and then following this trend by selling too low. And it just seems that no matter what you try and do, you're following this trend here and that trend there. No matter what trend it is, you see other people making tons of money on it, but it bypasses you. Have you ever wondered why that is? I wondered too at one point. And then I turned my investing life around by doing these 5 things. These 5 things before I ever really invest into single stocks. If you follow them as well, you're going to be successful at investing your money and not just flushing it down the toilet. Keep in mind that most of these things are really not talked about in the finance space for some reason. But we're going to go over them today. So let's get started. This one's going to be an obvious one. So brace yourself. But you need to understand the strategy of investing. It's obvious, but it's often overlooked. Now, a lot of folks will tell you that this is the most important thing about investing in stocks. And it is important. All the things on this list are important, as a matter of fact. But when it comes to preparing your mind and your finances for owning or trading stocks, successfully that is, of the important things you must do, this one is simply foundational. Meaning it's important. If you don't do it, you're not going to be successful. But there are other more important things to get done. Why is that? Why do I say that? Because the strategies that you understand and that you learn, well, they're going to change with market conditions and with your preferences. For example, ask yourself right now, are we on a bull run in the stock market or are we on a bear run? Is there rampant inflation throughout the economy, simultaneously affecting the buying public's purchasing power, which affects companies' bottom lines, which makes those companies less attractive to said buyers, which tends to make their stock prices fall, or at the very least be volatile. That's just one example. When market conditions change, your strategy should change, but your preparation for owning and trading stocks should always be the same and be rock solid. Like I said before, the strategies that you should know are important, and they include long-term investing. That is, stock market investing is generally more suited for the long term. And this is what your average investor typically tries to do. Now, with the long-term approach, you're benefiting from the compounding effect and the potential for capital appreciation over time. And because of this, short-term market fluctuations become less significant. With long-term investing, you can also implement dollar cost averaging. Dollar cost averaging is really investing a fixed amount of money at a regular interval, regardless of the stock price. By doing so, you buy more shares when prices are low and fewer shares when prices are high. This approach can help reduce the impact of market volatility, again, similar to long-term investing, and allows you to build your position gradually. Both of these strategies are similar to value investing. Value investing involves identifying undervalued stocks that have the potential to increase in value over time. Basically, you're trying to identify stocks that are trading below their intrinsic value, and you're aiming to benefit when the market corrects its pricing, assuming that the market becomes rational at any point. Growth investing, similar to value investing. It focuses on identifying companies with high growth potential. You've heard of investing in penny stocks. Well, that's kind of a riskier version of growth investing. Identifying companies that have innovative products or services, strong earnings growth and expanding market share, or maybe unheard of with any of these things. Growth investors typically pay a premium for such stocks, betting that their future growth will continue to drive their stock prices higher. A popular strategy on YouTube is dividend investing. Dividend investing involves buying stocks of companies that regularly distribute dividends. Now, dividends are a portion of a company's profits paid out to shareholders. Dividend investing can provide a steady stream of income, especially for income-oriented investors. Those are typically your older investors, but folks that really want to see their money pay them back as soon as possible. Dividend investing differs from growth investing in that growth investing typically focuses on newer companies, where dividend investing usually focuses on companies that have built a large market share and are sort of staples in the industry. Think of Coca-Cola, Procter & Gamble, those types of companies. Something that a lot of folks overlook is understanding the difference between trading and investing. And what is that difference? Well, the difference really is the time frame with which you're looking to invest. Let's take a look at a couple of examples to understand the difference. So day traders, well, they tend to have an extremely short time frame for recovering positive gain from the strategy that they're employing. They rely on signals to know when to buy or sell a stock, or when to go long or when to go short. These signals can include positive or negative news about things like earnings reports, product launches, mergers and acquisitions, regulatory changes, economic indicators. All of these things can significantly impact the stock price for a day trader. They can impact the stock price of a company, and this can influence the day trader to take a certain position or strategy. Not only that, but volume and liquidity. High trade volumes and liquidity they're important for day traders as they provide opportunities for quick entry and exit from trades. Stocks with significantly higher trading volume tend to have tighter bid-ask spreads, reducing transaction costs and increasing trade execution speed. Day traders love to look at technical indicators and patterns as well. This is what one would call technical analysis, as a matter of fact. Analyzing price charts, patterns, and various technical indicators such as moving averages, relative strength index, and Bollinger Bands, all these things and more help to identify potential entry and exit points based on historical price patterns. Following those price patterns can and does lead some day traders to profit extremely well. Other strategies that day traders tend to employ include market trend analysis. Analyzing broad market-based indices such as the S&P 500 or sector-specific indices to assess the prevailing market direction is a good way that day traders look to make a little bit of extra cash. Understanding the broader market context, whether or not the market is volatile, whether or not the market is going up, whether or not the market is in a bear position, whether the market is facing bear pressures, enables day traders to analyze their positions and their strategies and make the right move. There's more in-depth analysis to be had here, and there's a lot of great channels on YouTube that focus on this specifically. But again, understanding your strategy is only the first part. Understanding your strategy and having a plan to execute on that strategy, well, they're the least important things that you need to have down before you start to trade or invest. You need to make sure you can execute on those strategies. How can you do that, you may ask? The secret to really being a great trader or investor is to have confidence. That is to say, if you have low confidence, you're not going to be a great trader at all. If you have high confidence, well, you might not get rich, but you're definitely going to be in a position to make a lot more money. I'm talking specifically about your investing confidence. What is your investing confidence? What's your ability to make risky trades and follow a strategy and a plan without deviating? Because you're not worried about how that trade or investment will affect your net worth. Well, how do you get that kind of confidence? Well, you start with getting your credit right. Now this one seems like a non sequitur for this video and kind of counterintuitive. But trust me, it's important. You do realize that some of the more advanced trading and investing strategies involve leverage, right? And what do I mean by leverage? I mean borrowing money or other assets, execute certain strategies, including shorting stocks, trading on margin, heck, even something as simple as owning a rental property. That last one is definitely out of the scope of this video, but it is an example of using leverage to trade an asset if your credit is right. Banks and other financial institutions can trust that you will pay them back in a timely manner. There are a number of videos out there on how to get your credit right, and I have a couple on them on this channel, as a matter of fact. But a simple technique that you can use is to get a credit card that you can use to pay for your standard expenses, groceries, gas, or rent. Pay the bill in full every time, and don't have a revolving month-to-month balance to avoid interest charges. And boom, slowly but surely, sometimes even quickly, you'll have a sterling credit score. Now, there are more advanced techniques than this, and if you're already in copious credit card debt, that's a different discussion altogether. But there is no discussion about credit without talking about your personal debt-to-asset ratio. Debt-to-asset ratio? I bet you thought that's just one of those metrics that you should look to evaluate companies that you're looking to snap up in a value investing portfolio. Well, debt-to-asset ratio can apply to you, the erstwhile investor, as well. Now, what does that mean, though? It means that your net worth, essentially, should be made up of more assets than liabilities. Are you the type of person to go around quoting that you have a 7-figure net worth, but 90% of that net worth is a personal home you bought with 5% down and that you only have 15% equity in? Well, if that's the case, you're the type of person whose debt-to-asset ratio might be slightly askew. When taking account of your debt and your assets, you want to look at all the assets that you own. Quick example, perhaps you have a 401k. Maybe you have a coin collection. Maybe you own several crypto tokens, some single stocks, etc. You add all those assets and their current market value up, and you put that total on one side of the equation. And then look at all your liabilities. For example, maybe you owe money on a car loan, on student debt, on consumer debt. We talked about getting your credit right a little bit earlier. And I personally would include how much you owe plus interest on your personal property and your investment properties. Slightly controversial, but that's what I do. Divide those two numbers, and that is your personal debt-to-asset ratio. If that number is greater than 1, that tells you that your debt is under control and that your assets could cover all your debts in the event you had to liquidate everything. The more zeros you have at the end of your personal debt-to-asset ratio, the more wealth you actually have. Now, there is something to be said about being really indebted, particularly if those debts are around large purchases that cash flow, like, for example, a multifamily property or several lucrative franchise locations. Some would say it's the magnitude of the ratio and not necessarily the positivity or negativity of that said ratio, particularly for cash flowing. But if you're looking to buy single stocks, you will be in a power position if you maintain a positive debt-to-asset ratio. And the way to do this is to simply save. Saving so that you have cash in the bank to meet at least 3 months of expenses is a necessity. But once you do that, you need to save some more, particularly to a large, profitable portfolio. You see, you really don't start playing with real money until you hit about 100K in after-tax cash sitting in your bank account, ready to snap up any and all equities that you have your eye on. There are a number of ways to save. In fact, there are multiple types of accounts that you can use to save a sizable sum of money. You can forget about checking. Checking accounts are a way to have your money just waste away due to inflation, whether it's high or it's low. Your checking account should just have enough money in it to cover your monthly bills. I would steer clear of regular savings accounts as well. With high inflation, there are some high-yield savings accounts that are starting to offer better rates, but even with those high rates, you're still losing a significant amount of money to inflation. You're going to want to invest into certificates of deposits to really turn that money that you're saving into something that can be put into a solid investment strategy. Wait till I drop that video on CD ladders. That's right, CD ladders. You're going to want to make sure that you're subscribed so you can be one of the first to hear that uncommon knowledge. But this next secret might be something that is not often talked about in the finance space on the internet, but is probably the most important. You see, you want to have a long-term investment portfolio before you invest in single stocks. I know what you're thinking. Isn't this video about the things you should do before you buy stocks? You're probably scratching your head, getting ready to leave comments down below telling me how stupid I am. Just calm down, everybody. I can explain. Purchasing stocks, whether it's part of an intraday trading strategy or as part of a long-term investing strategy, can be one of the most lucrative things that you can do with your money that requires little or no work on your part other than doing the research and executing a strategy. Unlike investing in real estate, opening up your own business, or starting a startup. All those things require an immense amount of work on your part, in addition to you doing the research on all those things before you pull the trigger. Owning and trading stocks requires just the upfront research and basically just executing. And basically after that, you let the money roll in. And the best way to get a feel for that simplicity is to buy in with as low risk as possible, either by owning an index fund or an ETF that owns the broader market, or by having some tax-sheltered vehicle that can do all that for you. For example, a 401k, an IRA, something like that. That way, if you're paying close enough attention to how the market moves and how your wealth ebbs and flows with the market, you then get a sense for how it works and how it impacts your wealth. Bonus points. Leaving your money into one of those instruments guarantees you to make anywhere from 8 to 13% year over year on average. Some years you're going to lose, others you're going to win. Nevertheless, you'll be increasing your net worth on autopilot. Now, if you have all of those 5 things, you have a strategy, your credit is right, your debt to asset ratio is in place, and you have the savings to last not just your expenses, but to really power big moves that you can make, and you have experience with the stock market by owning a broader market index, you are now in a position to be a confident investor, someone who is ready to do the research and execute the strategy as a cold, calculating investing guru, and not a scarcity-minded gambler who's going from one strategy to the next, hoping to hit their next big score so they can pay off this month's mortgage. Speaking of gambling, take a look at this video of why owning your own home might not be the investment that you thought it was. And remember, a goal without a plan is a wish. A goal with a plan and no action is a wish list. I'll catch you in the next one. Like, subscribe, turn on post notifications, and I'll see you next time. Peace.